There is a profound and dangerous illusion at the heart of the modern financial world, an illusion so pervasive that it has become the default reality for millions. It's the flicker of green and red on a screen, the frantic dance of a ticker symbol, the breathless news alerts about a stock being up 3% or down 5%. We call this the market. We watch it, we react to it, we feel elation when it rises and a pit in our stomach when it falls. But this entire spectacle, this high-stakes digital drama, is a distraction. It is a grand misdirection that keeps 99% of participants locked in a cycle of speculation, anxiety, and ultimate mediocrity. Warren Buffett, a man who has built an empire of staggering proportions not in years but over decades, understood this illusion for what it was. He made a single foundational mental shift so powerful that it re-engineered his entire approach to capital and became the bedrock of his fortune. He decided to stop watching the stock market. He chose, instead, to start buying businesses. This is the final promise of investing. It is the promise that you can graduate from being a renter of stocks, a gambler on price wiggles, to becoming a true owner of productive assets. The principle is deceptively simple. Think of a stock as nothing more than a fractional ownership of a living, breathing business, and not as a ticker symbol to be traded. This single change in perspective prevents the most costly mistake in all of finance: the frantic, short-term trading based on charts, rumors, or the noise of financial media. It triggers a financial transformation, turning you from a speculator into a genuine business analyst. You begin to make decisions based on long-term profitability, competitive strength, and the quality of management. You begin to earn the returns that belong to business owners, not the scraps left for gamblers. Today, we are not just going to talk about this mindset, we are going to install it. We will deconstruct this philosophy into its core pillars, examine the psychological traps it helps you avoid, and provide the actionable blueprints to make it your own. This is the journey from reacting to the market to owning a piece of it, from chasing fleeting gains to building lasting generational wealth. This is where you stop being a retail investor tossed by the waves and start adopting the CEO mindset that builds empires. Our first pillar, the very foundation of this entire philosophy, is what we call the ownership mindset, acquiring a business, not a blip. It is the conscious decision to see every single stock purchase, not as a bet on a chart pattern, but as the acquisition of a tangible piece of a commercial enterprise. When you buy a share of a company, you are not buying a lottery ticket. You are buying a fraction of its factories, a piece of its patents, a claim on its brand recognition, and most importantly, a right to a portion of its future earnings. The ticker symbol is merely a receipt for this transaction. The stock price is simply the negotiation point. The real asset is the underlying business. To truly understand the power of this mental shift, we must travel back to one of the most bizarre and chaotic moments in Wall Street history. A moment that tested the resolve of every investor and separated the business owners from the stock renters. This is the story of the Great Salad Oil Scandal. The year was 1963. The world was on edge, still reeling from the Cuban Missile Crisis. But on Wall Street, a different kind of crisis was brewing, one centered on a company called Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. DeAngelis was a master of deception. His business was supposedly simple. He bought and sold vegetable oil, storing vast quantities of it in giant tanks in Bayonne, New Jersey. He used this inventory as collateral to secure massive loans from dozens of Wall Street firms and banks, including 2 subsidiaries of a titan of American finance, American Express. The problem was, the oil wasn't there. DeAngelis had devised an ingenious scam. He would fill the tanks mostly with water, with only a few feet of oil floating on top. When inspectors came to check the inventory, they would dip their measuring sticks in, see oil, and sign off on the collateral. For years he leveraged this phantom inventory to borrow more and more money, building a house of cards of unimaginable scale. In November of 1963, the house of cards collapsed. DeAngelis's company defaulted, the scam was exposed, and the market realized that the collateral backing hundreds of millions of dollars in loans, an immense sum at the time, was nothing but greasy water. Panic erupted. The firms that had lent him money were facing catastrophic losses. Among the hardest hit was American Express Warehousing, a subsidiary of the mighty American Express. The market's reaction was immediate and brutal. American Express, the blue-chip company known for its travelers' checks and credit cards, was now associated with one of the biggest frauds in history. The stock, which had been trading at over $60 a share, was annihilated. It plunged by nearly 50%, falling to $35. Wall Street was in a state of pure terror. Analysts and pundits declared that American Express's reputation was shattered beyond repair. They argued that its core business relied on trust, and that trust was now gone. Who would use an American Express traveler's check if the company itself was embroiled in a scandal of this magnitude? The herd was stampeding for the exit. Sell, sell, sell. This was the chorus on every trading floor. The ticker symbol, AXP, was a toxic blip on the screen. But in Omaha, Nebraska, a young Warren Buffett was not looking at the ticker. He was not listening to the panic. He was applying the ownership mindset. He asked himself a simple question. If I had the money, would I buy the entire American Express business at this price? The market was pricing the entire company at around $150 million. To answer his question, Buffett didn't look at a stock chart. He went to work as a business analyst. He began to investigate the fundamental reality of the American Express enterprise. He ignored the noise of the scandal and focused on the two core pillars of the business, the traveler's check division and the credit card division. He started by visiting his local Omaha banks. He would stand in line and watch customers. He saw them buying traveler's checks for their trips. He talked to the tellers, asking them if they'd seen any drop-off in demand for American Express traveler's checks since the scandal broke. The answer was a resounding no. People didn't connect the parent company's warehousing subsidiary with the trusted traveler's check in their pocket. Then he went to restaurants and hotels around Omaha. He sat down with the owners, his friends and acquaintances. He asked them about the credit card business. Did they still accept the American Express card? More importantly, did their customers still use it? Again, the answer was a powerful yes. The business owners told him that the customers who used the American Express card were their best customers. They spent more money. There was no way they would stop accepting the card. Buffett was digging into the reality of the business, not the perception of the stock. He realized that while the stock market was panicking about a headline, the actual earning power of the American Express business was completely unscathed. The scandal was a problem for a subsidiary, a painful and expensive one, but it did not damage the company's two great commercial engines. He concluded that the company was still earning about $10 per share. At a stock price of $35, he was being offered the chance to buy a world-class business for less than 4 times its annual earnings. This was the kind of deal a business owner dreams of. So what did he do? He acted not like a trader trying to catch a falling knife, but like a CEO executing a strategic acquisition. He invested 40% of his partnership's entire capital into American Express stock. It was the single largest investment he had ever made. Within a few short years, the market forgot about the salad oil scandal. It woke up to the reality that Buffett had already uncovered. American Express was a phenomenal business. The stock price soared, eventually tripling, and handed Buffett's partnership a colossal $20 million profit. This foundational anecdote reveals the core of the ownership mindset. While the rest of the world saw a terrifying plummeting ticker symbol, Buffett saw an opportunity to buy a wonderful business at a fire sale price. He ignored the blip and analyzed the business. This is the first and most critical step toward achieving true financial freedom. The reason Buffett's approach in the American Express situation was so effective, and why it is so difficult for most people to replicate, lies deep within the wiring of our brains. The ownership mindset is, at its core, a powerful antidote to a cluster of cognitive biases that are hardwired into our psychology through millennia of evolution. The most prominent of these is herd behavior, also known as the social proof bias. Humans are social creatures. For most of our history, our survival depended on our ability to stick with the tribe. If everyone in your tribe suddenly started running, You didn't stop to analyze the situation. You ran too. The person who paused to ask, "Is that really a lion or just the wind rustling the grass?" was likely to be eaten. This instinct to follow the crowd is deeply ingrained. In the financial markets, the herd is the constant stream of news, analyst ratings, and price movements. When a stock like American Express was plummeting, the primal, instinctual part of every investor's brain was screaming, "Everyone is running away from this. It must be dangerous. Sell now before it goes to zero." The emotional pressure to conform is immense. It feels safe to be doing what everyone else is doing, even if it's demonstrably irrational. Buffett, by forcing himself to think like a business owner, short-circuited this instinct. An owner doesn't ask, "What is everyone else doing with my business?" An owner asks, "How is my business actually performing?" By going out and conducting his own primary research, talking to bankers, restaurateurs, and customers, he was collecting his own data, creating his own reality separate from the market's panicked narrative. This is a crucial defense mechanism for any retail investor trying to achieve long-term portfolio growth. You must train yourself to see the market's herd-like movements as mere data points, not as instructions to follow. The second psychological principle at play is recency bias. This is our tendency to give greater importance to recent events than to historic ones. The market had known for decades that American Express was a stellar company with a powerful brand. But in the winter of 1963, all of that history was forgotten. The only thing that mattered was the recent, terrifying news of the salad oil scandal. The market's memory is brutally short. It extrapolated the recent disaster into a permanent state of ruin. The thinking went, the stock is down 50%, therefore the business must be 50% worse, and it will probably keep getting worse. This is the thinking of a ticker watcher. A business owner, however, has a longer memory. Buffett understood the long-term history of the brand. He knew its value had been built over generations. He saw the scandal not as a new permanent reality, but as a temporary, albeit severe, problem that could be quantified and ring-fenced. He calculated the maximum possible loss from the fraud, the absolute worst-case scenario, and compared it to the ongoing, robust earning power of the real business. He saw that the earnings would quickly overwhelm the one-time loss. He was weighing a single recent negative event against decades of positive business performance. The market was doing the opposite. This is why day trading is so psychologically taxing and financially ruinous for most. It forces you to operate in a world of pure recency bias, reacting to the last price tick, the latest news headline. The ownership mindset forces you to zoom out, to look at the multi-year, multi-decade trajectory of a business's health, which is far more predictive of long-term capital gains. By understanding these biases, the pull of the herd and the seduction of the recent, we can begin to appreciate why the ownership mindset is not just a clever investing technique, but a necessary psychological shield against our own worst instincts. So how do we as individual investors striving for financial freedom translate this powerful concept into a practical, repeatable process? We need a blueprint, a mental model that forces us to abandon the role of the stock picker and adopt the CEO mindset. The model is this, the one-page business acquisition memo. Before you are allowed to buy a single share of any company, you must be able to articulate your investment case on a single sheet of paper, as if you were presenting a proposal to a board of directors to acquire the entire company. This is not about complex financial modeling. It is about clarity of thought. This memo has 5 mandatory sections. First, the business in a sentence. You must be able to describe what the company actually does to make money in a simple sentence a 10-year-old could understand. For example, for American Express in 1963, it might have been, the company operates a global payment system, making money by taking a small fee on transactions made with its cards, and by selling trusted financial documents called traveler's checks. If you cannot articulate this simply, you do not understand the business well enough to own it. This step immediately filters out companies with convoluted or opaque business models, protecting you from things you don't comprehend. Second, the three key economic engines. What are the one, two, or at most three primary drivers of the company's profitability? Is it the number of users on its platform? The price it can charge for its product? Its ability to expand into new geographic markets? For Buffett's American Express, the engines were the growth in travel spending, driving travelers' check sales, and the growth in consumer spending on its credit cards. This forces you to move beyond vague platitudes like, "It's a good company," and identify the specific metrics that actually matter to its bottom line. This is pure business analysis. Third, the reason this business will be stronger in 10 years. This is where you think about the long-term competitive advantage or moat. Why will this company not only survive but thrive over the next decade? Is it a beloved brand? High switching costs for its customers? A unique technological advantage? A low-cost production process? Writing this down forces you to think about durability, a core component of the ownership mindset and the antithesis of short-term trading. Fourth, the smartest person I know would argue against this investment because this is the pre-mortem. You must actively seek out and articulate the strongest possible counter-argument to your own thesis. What are the biggest risks? What could go wrong? For American Express, the bear case was clear. The salad oil scandal will permanently tarnish the brand's reputation for trust, leading to a decline in the use of its cards and checks. By writing down the bear case, you prove to yourself that you have considered the downside and are not simply caught up in a bubble of confirmation bias. And finally, the fifth section, valuation. Why is it cheap? You must provide a simple, back-of-the-envelope justification for why the current market price offers a compelling value. It doesn't need a complex discounted cash flow model. It can be as simple as Buffett's logic. The market is valuing the entire company at $150 million, but the business consistently earns over $50 million a year. We are being offered the chance to buy this great franchise for less than 3 times its annual earnings, while the scandal is a one-time, containable loss. This forces you to connect the business fundamentals to the price you are paying. By committing to this one-page memo process for every single investment, you fundamentally change your relationship with the stock market. You are no longer a passive consumer of prices. You become an active business analyst, a capital allocator. You are building a portfolio of businesses you understand and can justify, which is the cornerstone of any serious wealth management strategy. Now let's contrast this deliberate, ownership-focused approach with the path taken by the vast majority of market participants. This is the antithesis, the path of the 99%, embodied by the character we'll call the ticker watcher. The ticker watcher wakes up, and the first thing they do, before even having a cup of coffee, is check their brokerage app. Their emotional state for the day is immediately set by the color they see. Green is a shot of dopamine. Red is a jolt of cortisol. Their investment strategy, if you can call it that, is purely reactive. They see a stock that is up 10% in the pre-market, and they feel a pang of FOMO, fear of missing out. They jump in, hoping to ride the momentum without any understanding of what the business does or what its long-term prospects are. They hear a rumor on a social media forum about a guaranteed breakout, and they place a trade. They see a scary headline on a financial news channel, and they panic sell a perfectly good company that is temporarily down. The ticker watcher's world is a two-dimensional screen. They see charts, not factories. They see patterns, not products. They see resistance levels, not brand loyalty. They are playing a game of predict the blip, which is, in essence, a high-stress, low-probability form of gambling. They are renting stocks, never owning them. The consequences of this approach are devastating. First, there are the massive transaction costs. The ticker watcher is constantly buying and selling, racking up fees and commissions that eat away at any potential gains. Second, there's the tax inefficiency. By selling within a year, any gains they do manage to secure are taxed at the highest possible short-term capital gains rates, a significant drag on portfolio growth. In contrast, The business owner who holds for more than a year benefits from much lower long-term capital gains tax rates. But the most insidious cost is psychological. The ticker watcher lives in a constant state of anxiety and second-guessing. They are perpetually unsure of their decisions because those decisions were not based on any deep conviction or analysis. They bought because the line went up, so when the line goes down, they have no logical reason to hold on. The business owner, who bought American Express because they understood its earning power, can watch the stock price fall 50% and not only hold on, but confidently buy more. The ticker watcher, who bought it at 60 because it was going up, is guaranteed to sell in a panic at 40. This path of the 99% is a hamster wheel of activity that leads to financial and emotional exhaustion. It's the very definition of confusing activity with achievement. It is the costly mistake that the ownership mindset is designed to prevent. Finally, we must trace the direct financial connection. How does this abstract concept of an ownership mindset translate into cold, hard numbers on your balance sheet? The impact is multi-layered and profound. First, as mentioned, it drastically reduces two of the biggest drains on investment returns: transaction costs and taxes. The business owner thinks in terms of years and decades. They might only make a few major investment decisions in a single year. The trader makes dozens, sometimes hundreds of decisions a month. The cumulative effect of these frictional costs over an investing lifetime is staggering. A mere 1 to 2% difference in annual returns, compounded over 30 or 40 years, is the difference between a comfortable retirement and true generational wealth. Second, the ownership mindset forces you to focus on the true source of all investment returns, the earnings of the underlying business. A stock's price can fluctuate wildly day to day based on sentiment and noise, but over the long run, it will inevitably follow the trajectory of the company's intrinsic value. A business that consistently grows its earnings per share at 15% per year will, over a decade, see its stock price follow a similar upward path, regardless of short-term volatility. By focusing on the business, you are anchoring your expectations to this fundamental reality. You begin to evaluate potential investments not on their price momentum, but on their free cash flow yield, the amount of cash the business generates relative to its market price. This is what a private equity firm does when evaluating an acquisition. It's the CEO mindset applied to public markets. For a retail investor, this is a revolutionary shift. It turns a speculative gamble into a rational calculation of return on investment. The ultimate financial advantage is building a portfolio that behaves like a collection of high-quality, cash-producing assets, not a collection of lottery tickets. Over time, these businesses will pay you dividends, they will reinvest their earnings to grow even larger, and their value will compound. This is how you achieve the kind of portfolio growth that leads to financial freedom. It's not about a single lucky trade. It's about the patient, deliberate accumulation of ownership in excellent businesses, purchased at sensible prices. This was the secret of the American Express investment, and it is the first and most powerful pillar of building wealth like a business owner, not a trader. The second pillar of the business owner mindset is what we call the moat mentality. Buying durability, not hype. If the first pillar teaches us to see a stock as a business, this second pillar teaches us what kind of business to buy. A true business owner isn't interested in a company that is popular today but might be gone tomorrow. They are searching for an enterprise with a protective barrier around it, an economic moat that defends it from competitors and allows it to generate high returns on capital for decades to come. This focus on durability is the ultimate rejection of the short-term hype that dominates so much of financial media. It's about buying a fortress, not a fad. And there is no better story to illustrate this principle than Warren Buffett's lifelong love affair with a simple, unassuming company that sells chocolate, See's Candies. In 1972, Warren Buffett and his partner Charlie Munger were presented with an opportunity to buy See's Candies. On the surface, it was not the kind of business that would excite a typical Wall Street analyst. It wasn't a technology company. It wasn't a fast-growing conglomerate. It was a family-owned chain of candy shops based primarily in California. They sold old-fashioned chocolates and candies from recipes that hadn't changed in 50 years. The business had been founded by Mary C. in 1921, and it had built a loyal following on the West Coast. The asking price was $30 million, but Buffett and Munger initially offered only $25 million. The C family held firm at 30. Blue chip stamps, the company Buffett and Munger were using for the acquisition, had only made about $40 million in profits over its entire history. Paying $25 million, let alone 30, was a massive bet on a box of chocolates. Charlie Munger, however, was adamant. He pushed Buffett to look past the simple financials and see the powerful, intangible asset the company possessed. He urged him to pay the full price. Buffett, still heavily influenced by his mentor Ben Graham's cigar butt approach of buying mediocre companies at dirt cheap prices, was hesitant. Paying a premium for quality was a new and slightly uncomfortable idea for him, but he trusted Munger's insight and agreed to the $30 million deal after some negotiation that landed them at $25 million net of excess cash. It was one of the most important decisions of his career. What Buffett and Munger saw in See's Candies was not just a company that sold sugar and cocoa. They saw a business protected by a deep and wide economic moat. The moat wasn't a patent or a complex technology. It was something far more powerful, an unshakable brand built on decades of customer happiness and nostalgia. In the mind of a Californian, See's Candies was not just candy. It was a part of life's celebrations. You bought a box of See's for your mother on Mother's Day. You gave it as a gift to a hostess at a dinner party. You brought it to the office during the holidays. It was a social ritual. This brand power gave See's an extraordinary advantage. Think about it from a competitor's perspective. Imagine you wanted to start a new candy company to compete with See's in California. You could replicate their recipes, you could build identical stores, you could even try to undercut them on price. But you could not replicate the 50 years of memories and positive associations that were baked into the See's brand. A young man giving a box of chocolates to his date is not trying to save $2. He is trying to make a good impression. He is not going to risk giving brand X chocolates. He is going to buy the trusted, beloved brand. This is a moat. This moat gave See's Candies incredible pricing power. Every year, after Christmas, Buffett and the team at See's would sit down and decide how much to raise prices for the next year. And every year, they would raise them significantly, and customers would barely blink an eye. They happily paid a little more for the same product because the value they were receiving wasn't just in the chocolate. It was in the brand, the nostalgia, and the social acceptance. Over the decades, this seemingly simple candy business became a cash-generating machine for Berkshire Hathaway. The initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire, profits that required very little additional capital investment. That $2 billion was then redeployed to buy other great businesses, compounding the initial gain exponentially. See's Candies taught Buffett one of the most important lessons of his career. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The wonderful part is the moat. He shifted from being just a brilliant financial analyst to a true connoisseur of business quality and durability. The See's Candies story is the perfect illustration of the moat mentality. It's about ignoring the fleeting hype of growth industries and focusing on the timeless, durable, competitive advantages that allow a business to stand the test of time and consistently reward its owners. The psychological reason the moat mentality is so powerful is that it acts as a direct counter-narrative to two of the most seductive and dangerous cognitive biases for investors: the narrative fallacy and the hot hand fallacy. The narrative fallacy, a term coined by Nassim Nicholas Taleb, is our tendency to create and believe simple, coherent stories to explain complex realities. The financial world is rife with these stories. This electric vehicle company is the next Tesla because its CEO is a visionary. This software company will change the world because it uses artificial intelligence. These narratives are compelling, easy to understand, and emotionally resonant. They are also often dangerously simplistic and devoid of any real analysis of the business's long-term competitive position. Hype chasers, the antithesis of moat investors, are addicted to these narratives. They buy the story, not the business. See's Candies had no exciting narrative. Its story was, "We make the same chocolates we did 50 years ago, and people still like them." This is a boring story, but it describes an incredibly powerful business reality. The moat mentality forces you to look beneath the sexy narrative and ask the hard, boring questions. Can competitors easily replicate this? What prevents customers from switching to a cheaper alternative? Will this business still be relevant in 20 years? It replaces storytelling with a rigorous assessment of competitive durability. The second bias it combats is the hot hand fallacy. This is the mistaken belief that because something has been successful recently, it will continue to be successful in the future. We see this constantly in the market. A particular technology sector gets hot, stocks within it soar, and investors pile in, assuming the hot hand will continue. They mistake recent price appreciation for a durable business advantage. This is classic momentum chasing. The investor who buys a stock simply because it has gone up 100% in the last 6 months is a victim of the hot hand fallacy. They are betting on the trend continuing, with no regard for the underlying business's moat or valuation. A moat, by its very nature, is a feature of a business that is independent of recent market trends. The brand loyalty of See's Candies existed long before Buffett bought the company, and it will likely exist long after we're gone. It is a structural advantage, not a temporary hot streak. Adopting the moat mentality requires a form of psychological discipline. It requires you to consciously reject the allure of a good story and the seduction of a rising stock price. It forces you to become a business realist, a student of industry structure and competitive dynamics. It's the difference between being an amateur speculator and a professional capital allocator. It's the CEO mindset, focusing on sustainable market position, something every entrepreneur understands is the key to long-term survival and prosperity. This deep-seated psychological shift is what enables an investor to build a portfolio that can withstand market cycles, technological disruption, and the relentless pressure of competition, ultimately fostering superior portfolio growth over the long run. To implement the moat mentality, you need a practical blueprint, a checklist that allows you to systematically identify and evaluate a company's competitive advantages. This is the Moat Analysis Checklist, a series of questions to guide your business analysis. There are 4 primary types of economic moats, and your potential investment should ideally possess at least one of them in a powerful form. First, intangible assets. This includes things like brands, patents, and regulatory licenses. The key question here is, does the company have a name or a legal right that allows it to sell a product for more than a competitor could sell an identical product? See's Candies is a brand moat. Coca-Cola is another classic example. A pharmaceutical company with a patent on a blockbuster drug has a patent moat. A company that owns the only license to operate a landfill in a major city has a regulatory moat. You must assess the strength and durability of this intangible asset. Is the brand getting stronger or weaker? When does the patent expire? Could the regulations change? Second, high switching costs. This moat exists when it is too expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Ask yourself, what is the pain point for a customer to leave this company? For example, your bank might not have the best customer service, but the hassle of moving your direct deposits, automatic bill payments, and linked accounts creates a powerful switching cost that keeps you there. Enterprise software companies are masters of this. Once a corporation has trained thousands of employees on a specific software suite, the cost and disruption of switching to a new one is immense. This is a very powerful, often hidden moat. Third, network effects. A business has a network effect when its product or service becomes more valuable as more people use it. The classic examples are social media platforms or credit card networks like Visa and American Express. The question is, does the value of the service to a new user depend on the number of existing users? Facebook is valuable because all your friends are on it. A new social network, even with better features, is useless if it's empty. A merchant has to accept Visa because billions of customers carry Visa cards. A customer wants a Visa card because millions of merchants accept it. This creates a virtuous cycle that is incredibly difficult for a new competitor to break into. Fourth, cost advantages. This moat allows a company to produce a product or offer a service at a consistently lower cost than its rivals. This can come from two main sources: process or scale. A process advantage might be a unique, proprietary manufacturing technique. A scale advantage comes from being so large that your fixed costs per unit are far lower than anyone else's. Ask, does this company have a structural cost advantage that allows it to either undercut competitors on price or earn higher profit margins at the same price? A company like Walmart or Costco uses its immense scale to negotiate lower prices from suppliers, a benefit it can then pass on to customers. A mining company that owns a uniquely rich ore deposit has a natural cost advantage. By systematically running a potential investment through this four-part checklist, you move beyond subjective feelings about a company and into a structured analysis of its competitive position. This is the core work of value investing and business analysis. It's how you find the See's candies of the world and avoid the fleeting, hyped-up story stocks that ultimately disappoint. Let's now examine the antithesis, the flawed approach of the 99%, which we'll call the path of the hype chaser. The hype chaser is perpetually on the hunt for the next big thing. They are not interested in the durable, boring businesses that form the backbone of a sound portfolio. They want excitement, they want a 10-bagger, and they want it now. Their portfolio is a graveyard of yesterday's hot narratives. They bought cannabis stocks when they were all the rage, only to see them crash. They piled into 3D printing stocks based on futuristic promises, then watched the industry fizzle. They bought any company that added blockchain to its name without any understanding of the technology. The hype chaser's decision-making process is the polar opposite of the moat analysis checklist. They don't ask about switching costs, they ask, how good is the story? They don't analyze cost advantages. They look at how many times the company has been mentioned on television that week. They are not conducting business analysis. They are consuming financial entertainment. A classic example would be the investor who, during the dot-com bubble, bought a company like Pets.com. The narrative was simple and seductive. The internet is the future, people love their pets, so a company that sells pet supplies online is guaranteed to be a huge winner. The company had a clever Super Bowl ad and a cute sock puppet mascot. It had hype in spades. But what did it have for a moat? Nothing. There were no significant switching costs. A customer could go to any number of other websites, or just go to their local pet store. There were no network effects. There was no cost advantage. In fact, shipping heavy bags of dog food made their costs higher than a brick-and-mortar store. And the brand, while momentarily famous, had no deep, multi-generational trust like See's candies. Pets.com was a business with no competitive advantage, no moat. It was a story, not a fortress. And predictably, when the hype faded and the capital ran out, the company went bankrupt, wiping out its investors. The hype chaser is doomed to repeat this cycle. They jump from one narrative to the next, always arriving late to the party and leaving with a financial hangover. Their portfolio experiences tremendous volatility, but little actual growth. This is the inevitable outcome of prioritizing exciting stories over durable business advantages. It's the path of speculation, not investment, and it is a world away from the patient, deliberate wealth creation of the business owner. The direct financial connection of the moat mentality is perhaps the most powerful in all of investing. A wide, durable economic moat translates directly into superior and more predictable financial performance, which is the engine of long-term capital gains. First, a moat manifests as pricing power. A company with a strong brand or high switching costs, like See's Candies or Microsoft, can raise its prices year after year without losing significant business. This ability to increase prices faster than inflation is a secret weapon for wealth creation. It directly leads to expanding profit margins. While a company in a fiercely competitive, commoditized industry sees its margins squeezed to near zero, the moated company enjoys fat, healthy margins. This shows up directly on the income statement. Second, a moat leads to a high return on invested capital, or ROIC. This is one of the most important metrics in business analysis. It measures how much profit a company generates for every dollar of capital it invests in its operations. Companies with wide moats, by their very nature, fend off competition. This means they don't have to constantly spend huge sums of money on price wars, marketing blitzes, or frantic research and development just to stay afloat. They can invest their capital in projects that generate high returns. See's Candies, for example, required very little new capital to grow its profits for decades. It was a cash-spewing machine. A high and sustainable ROIC is the financial signature of a great business. When you buy a stock, you are buying a piece of this ROIC. A portfolio filled with high ROIC businesses will compound its value far more effectively than a portfolio of mediocre, capital-intensive companies. Finally, a moat provides financial stability and predictability. The earnings of a moated company are less volatile and more forecastable. This stability is incredibly valuable. It means the company is less likely to face a cash crunch during a recession, more likely to be able to pay and grow its dividend, and its stock price will generally be less volatile. For the investor, this means a smoother ride and the psychological fortitude to hold on during market downturns, confident in the underlying strength of the businesses they own. In essence, the moat mentality is a strategy for tilting the odds dramatically in your favor. You are consciously choosing to invest only in the strongest, most resilient businesses in the economy. This is the financial result of thinking like a long-term business owner. You end up owning a collection of economic fortresses that generate predictable, growing streams of cash, which is the ultimate driver of wealth and financial freedom. The third pillar in constructing the business owner's mindset is a concept that flows directly from the first two. Once you've decided to buy a business, and you've identified a wonderful business with a durable moat, there is one final, crucial element. You must buy it at a sensible price. This is the principle of the price versus value disconnect, built around the core tenet of value investing, the margin of safety. The idea is simple but profound. The price of a stock as quoted on an exchange is often a wildly emotional and irrational number. The intrinsic value of the underlying business, however, is a much more stable, analytical figure based on its future earning power. The goal of the intelligent investor is to buy only when the price is significantly below that calculated intrinsic value. This gap, this discount, is your margin of safety. It is the buffer that protects you from bad luck, unforeseen problems, and your own inevitable errors in judgment. No story illuminates this principle more clearly than Buffett's transformative investment in the Washington Post. In 1973, the American stock market was a mess. The Nifty 50 bubble, a period where investors believed you could pay any price for a great growth stock, had just burst. The market was in a prolonged bear market, and sentiment was abysmal. It was a time of deep pessimism. Amid this gloom, the Washington Post Company, a venerable institution, went public. The company was controlled by the Graham family, particularly by the formidable Katharine Graham, and it owned not only the flagship newspaper but also Newsweek magazine and several highly profitable television stations. By any measure, these were high-quality assets. The newspaper had just broken the Watergate scandal, cementing its reputation as one of the most important journalistic outlets in the world. Yet, the market was utterly unimpressed. In the fearful environment of 1973, investors wanted nothing to do with stocks, especially newspaper stocks, which were seen as old media in a changing world. The stock price languished. The market was pricing the entire Washington Post Company at just $80 million. Warren Buffett, operating from his quiet office in Omaha, looked at this situation not as a stock picker, but as a business analyst looking for a bargain. He sat down and did the work. He analyzed each of the company's component businesses as if he were going to buy them outright in a private transaction. He estimated the value of the television stations. He calculated what Newsweek magazine would be worth to a private buyer. He put a price on the newspaper itself. After his conservative analysis, he concluded that the intrinsic value of the Washington Post Company's assets was, at a minimum, $400 million. And it was likely worth as much as $500 million. Let that sink in. The stock market, in its infinite wisdom and short-term panic, was offering to sell him a dollar bill for 20 cents. The price was $80 million. The value was at least $400 million. This colossal gap between price and value was his margin of safety. It was a chasm. He knew that even if his calculations were off, even if the newspaper business faced some headwinds, even if a recession hit, he had such a massive cushion that it was nearly impossible to lose money permanently. The disconnect was simply too large. So over the course of 1973, Buffett began buying shares of the Washington Post. He did it quietly, patiently, accumulating a stake of over $10 million, which was a huge sum for his partnership at the time. This was not a trade. It was the acquisition of a significant ownership stake in what he believed to be a fantastic collection of businesses at a ridiculously cheap price. He met with Katharine Graham to assure her of his long-term friendly intentions. He was joining her as a fellow business owner. The market, of course, continued to be pessimistic for a while. The stock price didn't immediately shoot up. A trader focused on price action would have gotten bored or scared and sold. But Buffett, the business owner, wasn't concerned with the daily wiggles. He was confident in the value of the assets he had purchased. He knew that over time, the market price would have to gravitate toward the business's intrinsic value. And he was right. As the years went by, the market's mood improved. The company's earnings grew, driven by its powerful media franchises. And the stock price began a legendary ascent. That initial $10 million investment would eventually become worth over $1 billion, a staggering 100-fold return. It became one of the cornerstone investments of Berkshire Hathaway, a testament to the power of buying wonderful businesses when they are temporarily hated by the market. The Washington Post story is the ultimate lesson in the price versus value disconnect. Price is what you pay, value is what you get. The goal is to get far more value than you pay for. That difference is your margin of safety, the single most important principle for preserving and growing capital over the long term. The psychological principle that makes the margin of safety so vital is its role as a powerful defense against two of the most destructive human emotions in investing, fear and greed, which manifest as specific cognitive biases. The first is loss aversion. Decades of research by psychologists like Daniel Kahneman and Amos Tversky have shown that for the human brain, the pain of a loss is felt roughly twice as intensely as the pleasure of an equivalent gain. Losing $100 hurts twice as much as finding $100 feels good. This asymmetry makes us incredibly risk-averse in some situations and foolishly risk-seeking in others. When an investor buys a stock and it immediately goes down, loss aversion kicks in with brutal force. The pain is intense. The instinct is to sell to make the pain stop, often locking in a permanent loss. However, an investor who buys with a large margin of safety has a psychological fortress against this fear. If you bought the Washington Post knowing it was worth $400 million but you paid only $80 million and the price then drops to $70 million, your reaction is not panic. Your reaction is excitement. Your thought process is, the market is now offering me $1 for 17 cents instead of 20. This is an even better deal. The margin of safety transforms a source of fear into a source of opportunity. It allows you to be greedy when others are fearful, precisely because your purchase was anchored to a rational calculation of value, not to a hope that the price would go up. The second bias it combats is anchoring bias. This is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In investing, the most common anchor is the current or recent stock price. An investor might see a stock that has fallen from $100 to $50 and think, wow, it's 50% off. It must be cheap. But this is a dangerous mental shortcut. The previous price of $100 is just an anchor. It has no bearing on the company's actual intrinsic value today. The business might have deteriorated so much that its true value is only $20, making the $50 price incredibly expensive. The margin of safety approach forces you to break free from this anchor. You don't ask, is the price lower than it was before? You ask, is the price substantially lower than my conservative estimate of intrinsic value? This requires you to generate your own anchor, your own calculation of value, rather than passively accepting the one the market gives you. This intellectual independence is a hallmark of the world's greatest investors. It's the ability to look at a ticker symbol quoting a price of $50 and see the number 20, or in Buffett's case with the Post, to look at a market capitalization of 80 million and see a value of 400 million. This is not some mystical ability, it is the disciplined application of business analysis, shielded from the psychological pull of loss aversion and the cognitive trap of anchoring. This is how a retail investor can adopt a professional, CEO mindset towards capital allocation. How can a regular investor, who may not have Warren Buffett's incredible mind for valuation, apply the margin of safety principle? The blueprint is to create a simplified intrinsic value calculation. The goal here is not to find the precise value of a business down to the penny. That's impossible. The goal is to determine if it's broadly obviously cheap. You are looking for the $400 million business on sale for $80 million, not the $400 million business on sale for $380 million. Here is a three-step process. Step 1. Determine the owner earnings. This is a concept Buffett popularized. It's a more realistic measure of a business's cash-generating power than the reported net income. A simplified formula is net income plus depreciation and amortization minus the average annual amount of capital expenditures needed to maintain the business's competitive position. You can find these numbers on a company's financial statements, the income statement and cash flow statement. This calculation gives you a rough estimate of the cash an owner could theoretically pull out of the business each year without harming it. For our purposes, let's say you analyze a company and find its owner earnings are consistently around $10 million per year. Step 2. Estimate a reasonable growth rate. Look at the company's past 10 years of revenue and earnings growth. Is it a stable, mature company growing at 3% a year, or a more dynamic company growing at 8%? Be conservative here. It's better to underestimate growth than to be overly optimistic. Let's assume our company is a stable business you expect to grow at 4% per year for the foreseeable future. Step 3. Apply a simple capitalization factor. This is the easiest part. Instead of doing a complex discounted cash flow analysis, we can use a simple multiple. For a high-quality, stable business, a reasonable price to pay might be between 10 and 15 times its current owner earnings. This is like saying you want a 6.7% to 10% initial return on your investment. Let's use a conservative multiple of 12. So, our company with $10 million in owner earnings has a conservative intrinsic value of 12 times $10 million, which equals $120 million. Now you have your anchor. Your work has told you that a fair price to pay to acquire this entire business would be about $120 million. The final step is to compare this to the current market price, the market capitalization, which is the stock price multiplied by the number of shares. If the market is pricing the company at $130 million, there is no margin of safety. You move on. If the market is pricing it at $100 million, it's getting interesting. But if the market, in a fit of pessimism, is pricing the entire business at only $60 million, half of your conservative estimate of its value, then you have found a potential Washington Post situation. You have a massive margin of safety. This simplified model isn't perfect, but it achieves the most important goal. It forces you to stop looking at the stock price and start thinking about the relationship between the price you are paying and the value you are receiving. It is a tangible, actionable blueprint for any investor wanting to emulate the business owner's approach to acquisitions. The antithesis to this disciplined, value-oriented approach is the path of the 99%, personified by the momentum investor. The momentum investor operates on a principle that is the polar opposite of the margin of safety. Their philosophy is to buy high and hope to sell even higher. They are not concerned with intrinsic value whatsoever. Their only metric is the stock's price trend. Their Bible is the chart, not the company's annual report. The momentum investor sees a stock that has recently broken out to a new all-time high and sees it as a buy signal. They interpret the high price as confirmation that the stock is a winner. They are attracted to stocks that are already expensive and are getting more expensive, believing that the trend will continue. This strategy can work, for a time, in a strong bull market. It feels exhilarating to be riding a wave of positive sentiment. However, it is a strategy built on a foundation of sand. The momentum investor has no anchor in reality. They have no idea what the underlying business is actually worth. Therefore, when the momentum inevitably shifts, when the story changes, when the market corrects, they have absolutely no basis upon which to make a rational decision. Their only signal, the upward price movement, has vanished. It is replaced by a terrifying downward spiral. Since they have no concept of the business's intrinsic value, they have no idea if the stock is now a bargain or if it's on its way to zero. Their only recourse is to sell, often at a substantial loss, to cut the pain. Think of the investor who bought a high-flying tech stock in late 1999. They paid a price that was perhaps 100 times the company's earnings, or in many cases the company had no earnings at all. They bought because the price was going up. When the bubble burst in 2000 and the stock fell 80%, they were left holding a catastrophic loss. A value investor, demanding a margin of safety, would have never bought that stock in the first place. They would have looked at the price, compared it to the value, and simply said no. The momentum investor's approach is a high-stakes game of musical chairs. It relies on being able to sell to someone even more optimistic, the greater fool, before the music stops. The business owner, by contrast, is not looking for a greater fool. They are looking for a great business at a price that makes rational, long-term economic sense. The path of the momentum investor is one of extreme emotional highs and devastating lows, a strategy that is utterly dependent on market psychology and devoid of fundamental business analysis. It is the surest way to separate yourself from your capital over the long run. The direct financial connection between the margin of safety and your portfolio's performance is twofold and critical for building lasting wealth. The first, and most obvious, is downside protection. The margin of safety is your primary defense against permanent capital loss. Investing is a game of probabilities. You will make mistakes. Your analysis will sometimes be wrong. A great business can be disrupted by a new technology. A recession can hit harder than expected. The margin of safety ensures that when these things happen, the damage to your portfolio is minimized. If you buy a stock for $50 that you think is worth $100, and it turns out you were wrong and it's only worth $70, you are still protected. You haven't lost money. But if you buy a stock for $95 that you think is worth $100, and it turns out to be worth $70, you have suffered a significant loss. Over an investing lifetime, avoiding large losses is actually more important than picking huge winners. A 50% loss requires a 100% gain just to get back to even. The margin of safety is the financial mechanism for avoiding those portfolio-crippling drawdowns. The second financial connection is asymmetric upside potential. A large margin of safety creates a skewed risk/reward profile that is heavily in your favor. When you buy that $100 business for $50, your downside is arguably limited. It's hard for a great business to become worthless, but your upside is 100% just for the price to return to fair value. And if the business continues to grow, your upside is even greater. This is what financial professionals call asymmetry. You are taking a limited risk to chase a much larger potential reward. This is how smart capital allocation works. Buffett's Washington Post investment was a classic asymmetric bet. His downside was protected by the immense value of the underlying assets. His upside was a return to fair value plus decades of future growth. which ultimately resulted in a 100-to-1 return. By consistently seeking out investments with a large margin of safety, you are systematically building a portfolio where the potential gains on your successful investments far outweigh the potential losses on your mistakes. This is not gambling. It is a calculated, business-like approach to stacking the odds in your favor, and it is the financial engine that drives the returns of a value-oriented business owner. The fourth pillar of the business owner mindset addresses a critical question: which businesses should you even be analyzing in the first place? The world is filled with thousands of public companies in hundreds of industries. It is impossible to be an expert in all of them. The solution is the principle of the circle of competence, investing only in what you truly understand. A business owner would never dream of buying a copper mine if they knew nothing about geology, or a biotechnology firm if they had no background in science. They would stick to industries where they have a genuine edge. An investor must do the same. This means having the intellectual humility to admit what you don't know, and the discipline to stay within the boundaries of what you do know. The most powerful illustration of this principle in action was not an investment Warren Buffett made, but a massive, career-defining investment he chose not to make. The late 1990s were a period of wild euphoria in the stock market, known as the dot-com bubble. A new paradigm had supposedly emerged: the internet. Technology companies, many of them with no profits and sometimes no revenue, were being valued at astronomical levels. Wall Street was in a frenzy. Analysts who had spent their careers analyzing price-to-earnings ratios were now justifying insane valuations based on eyeballs or clicks. It was a classic mania. Friends were getting rich overnight buying stocks with names like eToys and GeoCities. The pressure to participate was immense. During this period, Warren Buffett became a figure of public ridicule. He was mocked as a dinosaur, a relic from a bygone era who didn't get it. Barron's, a prominent financial magazine, famously ran a cover story in 1999 titled, "What's Wrong, Warren?" The article detailed his failure to invest in the hot tech and internet stocks, pointing out how his conservative approach was lagging the soaring NASDAQ index. He was accused of being out of touch, of missing the greatest wealth creation opportunity in a generation. He was invited to technology conferences, like the famous one hosted by Bill Gates, where the brightest minds in the industry tried to explain their businesses to him. And Buffett listened patiently. But his conclusion was always the same. He couldn't, with any certainty, predict what these technology companies would look like in 10 or 20 years. He couldn't identify which ones had durable, long-term competitive advantages. The industry was changing too fast. The winners of today could easily be the losers of tomorrow. He couldn't look at a company like Microsoft, despite his friendship with Gates, and confidently project its earnings a decade into the future with the same level of certainty that he could for a company like Coca-Cola or Gillette. So what did he do? He did nothing. He stood by year after year and watched as tech stocks soared to unbelievable heights. He admitted, publicly and without shame, "I don't understand these businesses." They were outside his circle of competence. His expertise was in understanding businesses with simple, predictable models, powerful brands, and long histories of profitability: insurance, consumer goods, banking. He was a master of analyzing those. He was an amateur when it came to network routers and software protocols, so he simply stayed put. He was not going to play a game where he knew he had a disadvantage. This decision looked foolish, even stubborn, for several years. But in March of 2000, the bubble burst. The NASDAQ index, which had peaked above 5,000, began a catastrophic collapse. It would eventually fall by nearly 80%, wiping out trillions of dollars in market value. The darlings of the dot-com era, companies that had been worth billions, went bankrupt. The investors who had chased the hype, who had invested in stories they didn't truly understand, were financially devastated. And Warren Buffett, the old-fashioned dinosaur, was fine. His portfolio of boring companies had held up remarkably well. By having the discipline to stay within his circle of competence, he had avoided the single greatest market crash of his generation. His decision not to invest was just as important as the investments he made. The circle of competence is not about being the smartest person in the room. It's about knowing the perimeter of your own knowledge and having the discipline to not venture beyond it. It is a principle of intellectual honesty that protects you from the siren song of industries you do not and cannot understand at an expert level. The underlying psychological principle that makes the circle of competence so crucial is that it is a direct and powerful antidote to overconfidence bias and its dangerous cousin, the Dunning-Kruger effect. Overconfidence is one of the most pervasive and destructive biases in finance. We all tend to overestimate our own abilities and the precision of our own knowledge. An investor might read a few articles about a new technology like gene editing, feel like they have a good grasp of it, and then proceed to invest a significant portion of their savings into a speculative biotech company. They mistake a superficial familiarity with genuine, deep understanding. This is incredibly dangerous. The financial markets are a professional arena. When you buy a stock, you are competing against thousands of other brilliant, well-informed analysts, hedge fund managers, and industry insiders who have dedicated their entire lives to understanding that specific sector. If you are investing outside your area of expertise, you are the patsy at the poker table. The circle of competence is a tool of intellectual humility that forces you to ask, do I have a genuine, demonstrable edge in understanding this business compared to the thousands of other smart people looking at it? For most industries, for most people, the honest answer is no. The Dunning-Kruger effect is a cognitive bias whereby people with low ability at a task overestimate their ability. In other words, people who know a little bit about a subject often don't know enough to realize how little they know. A novice investor might have a few successful trades in an industry they don't understand, purely due to luck in a bull market. This initial success can lead them to believe they are an expert, causing them to make larger and more reckless bets. They are standing on Mount Stupid, as the Dunning-Kruger chart famously illustrates. The discipline of defining and staying within a circle of competence is a way to protect yourself from your own potential incompetence. It forces you to operate only in areas where you have put in the work to move beyond novice-level understanding. By consciously saying, I will not invest in biotechnology because I am not a scientist, or I will avoid complex derivatives because I am not a mathematician, you are building a firewall against the Dunning-Kruger effect. You are acknowledging that you would rather earn a satisfactory return in an area you understand than chase a spectacular return in an area where you are in reality just gambling. This humility is a superpower in a market that constantly rewards and encourages overconfidence and speculation. It's a core component of a CEO mindset, where a leader knows to rely on their expert teams rather than pretending to know everything themselves. So how do we create a practical blueprint for defining and operating within our own circle of competence? The mental model is an exercise called competence mapping. This is a deliberate process of identifying your areas of expertise and, just as importantly, your areas of ignorance. Take a sheet of paper and divide it into 3 columns. The first column is titled The Expert Circle. In this column, you list the industries, businesses, or technologies where you have deep, personal, or professional knowledge. This is not about what you've read in the news. This is about where you have a real, unfair advantage. Did you work in the retail industry for 20 years? You likely have a deep understanding of supply chains, merchandising, and consumer behavior. That's in your circle. Are you a software engineer? You have a massive edge in evaluating enterprise software companies. Are you a doctor? You can analyze healthcare companies in a way a financial analyst never could. This circle might be very small, and that's okay. Buffett's is famously small. The key is honesty. Don't list an industry here unless you could confidently debate an expert in the field and hold your own. The second column is titled The Learning Circle. These are industries that you find interesting and are actively, seriously studying. You are not yet an expert, but you are putting in the work, reading industry trade journals, studying the financial statements of the top companies, learning the key metrics and competitive dynamics. This is where you might be expanding your circle of competence over time. But you do not invest in this circle yet, you only study. The third and most important column is titled The Too Hard Pile. This column will be the longest. This is where you list everything else. Complex financial institutions, speculative biotech, semiconductor manufacturing, emerging market politics. Any area where you know you are at a significant knowledge disadvantage. You make a conscious, written commitment to never invest in companies from this column, no matter how exciting the story sounds or how much the stock is going up. This competence mapping exercise is a powerful act of self-awareness. It transforms a vague concept into a concrete, personalized investment policy statement. It gives you a filter through which you can view all potential investments. When a new idea comes across your desk, your first question is not, "Is this a good company?" It's, "Which of my 3 columns does this belong in?" If it's in the too hard pile, you dismiss it instantly and move on, saving yourself countless hours of wasted research and protecting yourself from making a catastrophic mistake. The antithesis of this disciplined approach is the path of the 99%, embodied by the character of the dabbler. The dabbler's portfolio is a mile wide and an inch deep. They own 50 different stocks in dozens of different industries. They have a little bit of a solar energy company, a piece of a Chinese e-commerce giant, a few shares of a cruise line, a small position in a pharmaceutical company working on a new drug, and so on. They have heard a compelling story about each of them, but they have a deep understanding of none of them. The dabbler is a collector of stock tickers, not an owner of businesses. Their research consists of reading a few headlines, seeing a positive analyst report, or getting a tip from a friend. They mistake this superficial familiarity for competence. This approach, which is often misguidedly called diversification, is actually what Buffett calls diversification. It leads to a series of predictable and negative outcomes. First, it guarantees mediocre returns. By spreading your capital so thinly across so many holdings, the impact of your best ideas is diluted by the weight of your average and poor ideas. It's nearly impossible to significantly outperform the market average when you essentially own a little bit of everything. True wealth is built through concentrated bets in your best, most well-understood ideas. Second, it creates a false sense of security. The dabbler thinks they are safe because they are diversified, but in reality, they are ignorant. They don't truly understand the risks inherent in each of their 50 holdings. When a crisis hits a specific industry in their portfolio, they won't have the deep knowledge required to assess whether it's a temporary problem or a permanent impairment of the business. Their only option is to react emotionally, usually by selling at the worst possible time. Third, it's impossible to manage effectively. No individual investor has the time or mental energy to properly follow 50 different companies. You can't read all the annual reports, listen to all the conference calls, and stay on top of the competitive landscape for dozens of industries. The dabbler's portfolio is not managed, it is simply curated. It is a museum of past tips and forgotten stories. The path of the dabbler is a direct result of ignoring the circle of competence. It stems from a lack of intellectual humility and a desire to participate in every story the market tells. It is a strategy that leads to a cluttered portfolio, a confused mind, and ultimately, deeply unsatisfying financial results. The direct financial connection of adhering to your circle of competence is subtle but enormously powerful. It's about improving the quality of your decisions, which directly translates to better long-term returns. First, it leads to higher conviction. When you invest in a business you understand inside and out, you develop a deep conviction in its long-term prospects. This conviction is a financial asset. It's what allows you to make a large, concentrated investment instead of timidly spreading your money around. As Mark Twain supposedly said, "Put all your eggs in one basket and watch that basket." The history of great fortunes is not a history of broad diversification. It's a history of concentrated, high-conviction bets. The circle of competence is what gives you the intellectual and emotional foundation to make those bets. Second, it creates an information advantage, or at least mitigates your disadvantage. By focusing on a narrow area, you can go deeper than the average generalist analyst. You can develop a level of expertise that allows you to spot opportunities and risks that others miss. You can read between the lines of an annual report because you understand the industry jargon. You can assess a new product's potential because you understand the customer. This informational edge, however small, can be the difference between a winning and losing investment. It directly improves your odds of success. Finally, and most importantly, it dramatically reduces the risk of making a zero. A zero is an investment that goes bankrupt or loses nearly all of its value. These are the portfolio killers. Most massive investment mistakes happen when people venture into areas they don't understand: speculative technology, complex financial products, fraudulent companies. By staying within your circle of competence, you are largely investing in established businesses with understandable models. While these can still be poor investments if you overpay, they are far less likely to become complete wipeouts. By systematically avoiding the kinds of companies and industries that are prone to catastrophic failure, you are practicing a powerful form of risk management. The financial result of this discipline is a portfolio characterized by fewer, better understood, higher conviction positions. This leads to a lower probability of major errors and a higher probability of the asymmetric returns that come from making a concentrated bet on a great business you truly understand. It's the path to building a robust, anti-fragile portfolio capable of generating real wealth. Our fifth and final pillar is arguably the one that separates the truly wealthy from the merely well-off. It is the force multiplier for all the other principles. It is the idea of the infinite horizon, the power of permanent capital. Once you have adopted the ownership mindset, identified a moated business, bought it with a margin of safety, and confirmed it's within your circle of competence, the final step is to do the hardest thing of all: nothing. A true business owner doesn't build a company with the goal of selling it next year. They build it to last for generations. The investor with a business owner's mindset must adopt the same perspective. Your preferred holding period for a great business should be forever. This long-term view is what unlocks the almost magical force of compounding, the engine that built Buffett's fortune and is the key to achieving profound financial freedom. The most iconic story to demonstrate this principle is Buffett's landmark investment in the Coca-Cola Company. In the summer of 1988, Warren Buffett began accumulating a massive position in Coca-Cola. This was not a quick trade. Over a period of several months, Berkshire Hathaway invested over $1 billion to acquire a stake of about 6% of the entire company. This was an elephant of an investment, even for Berkshire. The decision was rooted in decades of observation. Buffett had been a customer of Coke since he was a child. He saw its simple, powerful business model firsthand. But the specific catalyst came after the stock market crash of October 1987. In the aftermath of the crash, even the best companies in the world were trading at depressed prices. The market was gripped by fear and uncertainty. Buffett, however, saw an opportunity to buy a permanent franchise at a temporary discount. He applied his checklist. Was it a business he could understand? Absolutely. It sold sugar water, a simple concept. Did it have a moat? It had one of the most powerful moats in history, its global brand, a name recognized in the most remote corners of the planet. Was it on sale? After the crash, he believed the price offered a reasonable, if not spectacular, margin of safety. He saw a business that could continue to grow its earnings for decades to come as it expanded internationally. But the most important aspect of this investment was the mindset with which he made it. In his 1988 letter to shareholders, Buffett wrote about his ideal holding period. In fact, he wrote, "When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever." This was a radical statement in a Wall Street culture obsessed with quarterly performance and year-end bonuses. He wasn't buying Coca-Cola with a price target in mind. He wasn't thinking about when he would sell. he was thinking of himself as a permanent part owner of the business, alongside every other shareholder. He was mentally prepared to hold the stock for the rest of his life. And that is largely what he has done. For over 3 decades, Berkshire Hathaway has held its stake in Coca-Cola. The company has faced challenges: the rise of healthier drinks, management missteps, changing consumer tastes. A short-term trader would have been shaken out of the position a dozen times over. But Buffett, the business owner, held on, confident in the company's long-term durability and its ability to adapt. What was the result of this infinite horizon? That initial $1 billion investment has paid Berkshire many billions of dollars in dividends alone. The annual dividend Berkshire now receives from Coca-Cola is more than half of its original purchase price. The stake itself, despite the stock's ups and downs, is worth well over $20 billion today. But the true genius is how the principle of permanent capital works. Those billions in dividends from Coke weren't spent. They were redeployed as fresh capital to buy other great businesses, which in turn generated their own profits and dividends, creating a compounding cascade of unbelievable power. The Coca-Cola investment is the ultimate testament to the infinite horizon. It demonstrates that the greatest returns don't come from brilliant timing or frantic trading, but from buying a wonderful business and then letting the relentless silent power of compounding do the heavy lifting for you over a very, very long time. The psychological principle underpinning the infinite horizon is its function as a potent antidote to 2 of the most powerful and hardwired human biases: hyperbolic discounting and action bias. Hyperbolic discounting is our brain's tendency to strongly prefer smaller, immediate rewards over larger, later rewards. It's why so many people struggle to save for retirement. The immediate pleasure of spending $100 today feels much more compelling than the abstract, distant reward of having thousands of dollars in 40 years. In investing, this bias manifests as an obsession with short-term gains. An investor might buy a great company, see it go up 20% in 6 months, and feel an overwhelming urge to sell and lock in the gain. The immediate reward of seeing that realized profit in their account is more psychologically potent than the much larger but uncertain reward of holding for 20 years and potentially seeing a 10,000% gain. The infinite horizon mindset is a conscious and deliberate rebellion against this instinct. By mentally framing your holding period as forever, you are reprogramming your brain. You stop asking, "Should I sell today?" and start asking, "Has the long-term, multi-decade business case for this company fundamentally broken?" This is a much higher bar, and it prevents you from making the costly mistake of selling your biggest winners far too early, which is one of the primary reasons most investors underperform. The second bias it overcomes is action bias, our innate compulsion to do something rather than nothing, even when inaction is the more rational choice. In the wild, this was a survival trait. If you heard a noise in the bushes, it was better to act, run, than to do nothing and risk being eaten. But in the modern world of investing, this bias is lethal. The constant stream of news, price updates, and expert opinions creates a feeling that we must constantly be reacting, adjusting, buying, and selling. The financial services industry is built to encourage this bias, as more action means more commissions and fees. Sitting still and doing nothing feels passive and unproductive, yet for the long-term investor, it is often the most productive action of all. Adopting the infinite horizon gives you a powerful justification for inaction. When the market is volatile and your friends are frantically trading, your policy of permanent ownership gives you the discipline to simply sit on your hands. You recognize that most of the action is just noise and that the real work was done up front when you selected a great business at a fair price. This patience is not passive. It is an active and aggressive form of discipline. It is the understanding that in the race to wealth, the tortoise who compounds steadily almost always beats the hare who sprints and rests. It's the ultimate CEO mindset, focusing on the long-term strategic vision, not the daily operational noise. To put the infinite horizon into practice, we need a blueprint that changes how we monitor and evaluate our investments. The model is the Quarterly Portfolio CEO Report. Instead of checking your stock prices every day, you should treat your portfolio like a CEO managing a holding company of different business units. Once a quarter, you sit down and write a one-page report to yourself, the chairman of the board. This report has 3 sections. Section 1, Business Unit Performance Review. In this section, you list your holdings, but you do not list their stock price performance. Instead, you list their business performance. Go to the company's latest quarterly report or press release. Did revenues grow? Did profit margins expand or contract? Did they launch a successful new product? Did they gain market share? You are evaluating them as a CEO would evaluate a subsidiary. Is this business unit executing on its strategic plan? You are completely ignoring the stock market's opinion. Section 2. Reassessment of the long-term thesis. For each holding, you answer a single question. Has anything happened in the last 90 days that has permanently damaged this company's long-term economic moat or earning power? A competitor's new product launch probably doesn't qualify. A bad quarterly earnings report due to temporary factors doesn't qualify. A stock price decline definitely doesn't qualify. You are looking for game-changing structural shifts. A new technology that makes their product obsolete might qualify. A massive accounting scandal might qualify. A permanent loss of their brand's trust might qualify. This forces you to distinguish between temporary headwinds, noise, and permanent business impairment, a valid reason to consider selling. Section 3. Capital Allocation Decisions. Based on the first 2 sections, you decide what to do. If a business unit is performing well and the long-term thesis is intact, the default decision is do nothing. If you have new cash to invest, you might decide to add to your most promising business unit, especially if its stock price has been weak despite strong business performance. The only time you consider a sell decision is if you answered yes in Section 2, that the long-term case is truly broken. This quarterly review process fundamentally reorients your entire approach. It transforms you from a reactive stock price checker into a proactive, long-term business owner. It imposes a structure of patience and forces you to make decisions based on business fundamentals, not market sentiment. It is the operating system for executing the infinite horizon strategy. The antithesis of this patient, long-term approach is the path of the 99%, embodied by the impatient flipper. The flipper's mantra is, "You can't go broke taking a profit." While this sounds prudent, it is one of the most wealth-destroying aphorisms in finance. The flipper is governed by the psychological biases we just discussed. They buy a stock, it goes up 25%, and the urge to sell and realize that gain becomes overwhelming. They sell, pat themselves on the back for their cleverness, and then watch in agony as the stock goes on to become a 10-bagger over the next decade. They have sold their flowers to water their weeds. What does that mean? The flipper also has a hard time admitting mistakes. When a stock they buy goes down, they don't sell. They hold on, hoping it will come back to even, so they can get their money back without taking a loss. The result is a portfolio where the best-performing assets are constantly pruned, and the worst-performing assets are allowed to grow and dominate. Their portfolio becomes a garden full of weeds and stumps where beautiful trees used to be. This behavior is a direct consequence of a short-term, price-focused mindset. The flipper is not thinking about owning a business for a decade. They are thinking about flipping a stock for a quick gain. This leads to a portfolio with a constant, high turnover rate. They are always busy, always trading, but their net worth goes nowhere. They are trapped on a treadmill of their own making, a cycle of cutting winners short and letting losers run. This is the exact opposite of how great fortunes are built. The business owner's approach is to do the reverse, add to your winners when the opportunity arises, and decisively cut your losers when the business case is proven to be broken. The impatient flipper's path is one of guaranteed mediocrity, a cautionary tale of what happens when you let short-term emotions dictate long-term capital allocation decisions. The direct financial connection of the infinite horizon is the most beautiful and powerful in all of finance, the mathematics of compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. The infinite horizon is the key that unlocks its full power. Let's look at the numbers. If you achieve a 10% annual return, a $10,000 investment will grow to about $26,000 in 10 years. That's good. But if you leave that same investment to compound at the same rate for 40 years, it does not become 4 times larger. It becomes 45 times larger, growing to over $450,000. The vast majority of that gain happens in the later decades. That is the magic of compounding. The flipper who sells after a few years never allows this magic to happen. They are perpetually resetting their compounding clock back to year one. The long-term business owner, by holding on, allows the snowball to roll down the hill, gathering more and more mass and momentum over time. Furthermore, the infinite horizon maximizes tax efficiency, which supercharges compounding. By not selling, you are deferring capital gains taxes indefinitely. That tax money, which the flipper has to pay to the government every year, remains inside your investment, compounding for your benefit. This tax deferral acts as an interest-free loan from the government, and over decades, it makes a monumental difference in your final net worth. Finally, for companies that pay dividends, like Coca-Cola, the infinite horizon creates a powerful, growing stream of income. Reinvesting those dividends buys you more shares, which then pay you more dividends, creating a virtuous cycle of accelerating wealth. Over time, it's possible to be receiving more in annual dividends than your entire original investment cost, as is the case for Berkshire with Coca-Cola. The financial outcome of this pillar is transformative. It shifts your focus from earning income through activity, trading, to building wealth through ownership. It allows the mathematical certainty of compounding to work its inexorable magic on your behalf. It is the final and most powerful piece of the puzzle, the mechanism that turns a series of good investment decisions into a lifetime of financial independence and generational wealth. You have just navigated the 5 foundational pillars of Warren Buffett's business owner mindset. You have absorbed the mental shift from renting tickers to owning enterprises. You have learned to demand the protection of a durable economic moat. You have internalized the discipline of buying with a margin of safety, anchored to intrinsic value. You have embraced the humility of operating only within your circle of competence, and you have grasped the immense, world-altering power of the infinite horizon. This is not just a collection of investing tips. This is a complete operating system for thinking about capital. A mental toolkit that shields you from the psychological biases and market noise that derail the vast majority of people. You now possess the framework that is responsible for building one of the greatest fortunes in human history. Acknowledge the significance of what you have just learned. This is the foundation upon which all lasting wealth is built. But understand this, a foundation, no matter how strong, is still just the beginning. This mindset is the engine, but an engine needs a map to know where to go. You have mastered the why and the what to look for in a business. But Buffett's system is a network of interconnected mental models. The next layer, the piece that connects this foundational mindset to real-world execution, is understanding how much the specific quantitative tools of valuation that allow you to confidently identify when the market is offering you that once-in-a-decade bargain, the Washington Post on sale for 20 cents on the dollar. The journey does not end here. The video that is now appearing on your screen is not just another video, it is the next piece of the map. It is the bridge between the qualitative art of business analysis and the quantitative science of valuation. It is the link that connects everything you have just mastered to actionable, real-world numbers. The average person, the speculator, the ticker watcher, stops here. They feel they have learned enough. But you are not the average person. You are on a different path. You are not collecting trivia. You are building a complete mental arsenal for achieving financial sovereignty. The decision to click is not about watching another video. It is a commitment to continue your ascent, to complete your toolkit, to become not just a student of this philosophy, but a master of its application. The next piece of the puzzle is waiting for you. Continue your journey, complete the map, click the video,